In this video, we're going to talk about trading key levels. And ultimately what that is just being aware about the environment around you and the bigger levels that are around you so that you can take better trades, take higher probability trades. So this isn't an entry technique in isolation or anything like that. It's more a tool that you can use to increase your strike rate to become a better trader. So what are key levels? Well, key levels are major support and resistance levels that price interacts with over and over and over and over again. They're horizontal lines on your charts. So they're lines that will go from the left-hand side to the right-hand side of your screen, okay? And you will see that price will come back to them over and over again. So maybe 4 years ago, price came down to this level, reacted with it, reversed, and then went on a massive rally. You can then expect the next time that price comes down to that level again, it's going to interact with it in one way or another. Okay, now it's important to understand that levels on the higher time frames are going to be more significant than the levels on the lower time frames. So if you're looking at something on the weekly chart, it's going to be more important or more significant than a level on the daily chart and the 4-hour chart, and so on and so forth. But what the most important thing to understand here is that these levels are big levels. They're where the big money come to play it out. Okay, they're not going to be levels that you're going to see used every single day. Okay, they may be levels that were touched 20 years ago, but then you're coming up to that level again. And remember, the market has a memory, and the bigger players will be looking at these levels, so you can expect something to happen at that particular level. You know, it's going to trigger volatility in one way or another. So price is either going to break through the level and add momentum to a trend, or the level is going to act as a catalyst for a trend reversal or initiate a pullback. But ultimately, at these big levels, something is going to happen. And in a few minutes, or in the second part of this particular video, we'll show you how to go about identifying these levels and which are the levels that you're interested in. What we need you to understand now is the significance of these levels and ultimately how you need to treat them, how you need to go about trading around them. Okay, so don't worry about too much about the way that you're going to identify them, because we'll do that in the second part of this particular video. What we're doing in this video here is we just need you to understand the principles and understand the significance of them. So these key levels are levels where the big money will affect the market. Okay, major stops are going to be placed on the other side of these levels, and buyers and sellers will use them as reference points to pick their next trade idea. Okay, so if you think about the stops being on the other side of these levels, what can you expect? If stops are placed to the other side of levels, you can either expect a big momentum when the price breaks through the level, okay, indicating that the level does hold some weight, but now, you know, the trend is going to continue and with some volatility. Or if you're expecting stops one side of the level, the market breaks through that level, but fails to pick up momentum and then starts to trade back through the level again, that's an indication that actually this level is going to hold, because despite all of those stops that were placed the other side, you know, the dominant force in the market that's supporting that particular level, they're not about to give it up, and they're going to keep pushing it in the direction that it just came from. So the level will then act as a point where the market will bounce from. Okay, now provide you with two different opportunities. The first opportunity is to trade from the levels. Okay, so using one of the entry techniques that we've shown you, with some of the other technical analysis tools that we've shown you, you can use that particular level as an opportunity to make money. So you either trade the breakout from the level, or you can trade the bounce from the level. The other way that you can use these levels, key levels, as opportunities in the markets, is an opportunity to prevent you from losing money. So to protect your trading capital. Now, how does that work? Well, ultimately, if you're looking to take a trade which is going to take you directly into one of those levels, then sometimes it's a better idea actually not to take the trade at all, to kind of step to the sidelines and say, you know what, actually this trade, even though it looks good from a technical perspective, when I look at the key level, when I look at what I'm trading into, it doesn't make any sense. Okay, and that can save you a lot of money in the long run. And actually, you know, I've mentioned a couple of times before that, you know, we've had some members who have found that aha moments. And this is, again, one of those lessons that for some of our members completely changed their trading around. They looked at this and they said, Okay, fair enough. So I'm taking trades that don't really stand any chance of success whatsoever. I'm taking trades that make absolutely no sense because I'm taking it into a big level. Okay, and hopefully you guys will get to that understanding soon as well. So when we get to the second part of this video, when we look at the live charts and I show you how to identify them, you'll start to appreciate how the markets treat these levels. And when you start to appreciate that, you'll understand why it's not a good idea to take trades into these levels. So just to illustrate this very quickly on the slides before we get into the live markets, take a look there at that level that's in front of you. Okay, the 12880 level. All right, I've marked that on the chart there. What happened? The market comes down to that particular level over here. The market comes down and it reverses completely. So it's a big level. We're not talking about these kind of small levels here. The markets have rallied through the level, it's pulled back to the level, and then it's used it as a level to then rally from. Okay, and this is in 2009. And it's a big level because the market hasn't just kind of dilly-dallied around that level. It's completely reversed. And you can see the market's gone from 12900 all the way up to 1251 without really looking back at all. Okay, so that's the first time the market identified that level. So what about the next time the market identifies that level? And we're not talking next week or the week after. Okay, so we're talking about 2009 here. All right, 2009. Let's step forward to 2011. The next time the market comes back to that level 2 whole years later, look at what happens. Can you see? So 2 whole years later, the market's come back to that level that it bounced from in 2009. And what happens? As soon as the market gets to that level, bang, bounces off of it and absolutely reverses. Doesn't look back again. So it goes from 129 all the way up to 1.50. So the move is even bigger than the previous move. And you can bet your bottom dollar, the next time the market came back to this level, it bounced off of it again as well. Okay, now I'm not going to say it's going to hold forever because we know it won't. At some point it will break through it. But when it breaks through it, it will break through it with momentum because all of these people here that believed in this level before will believe in it again. And where will be the logical place that they'll place their stop? Behind the level. So if the market eventually manages to get down below that particular level there, they're not only going to get the sellers who want to be short below that level, they're also going to get the buyers that were long above this level with their stops below it. And to get out of a buy position, you need to sell. So all of those buyers that were supporting this level here will decide to get out when the market gets below that level. To get out of their position, they need to sell it. So you're going to have a wall of sellers below that particular level, which is why you expect momentum below those levels, okay? The other side of those levels, because you have all of those market participants. You have the people that want to trade the break through the level, and you also have those people, those participants that have their stops the other side of the level. Everybody getting involved there will cause momentum in the markets. If you don't get the momentum, then that's kind of like your first clue that actually that particular level may not hold as much weight as you initially thought it did, okay? Now remember that trading isn't 100% business. So just because I've shown you this here doesn't mean that you're never going to take another loss or that every trade that you take from that level is going to make you money. But it is another tool that you have. It's another thing that you can look at to filter out bad trades and to ensure you're taking good trades. Okay, does that make sense to you all? So on the next video, I'll go and show you how we go about identifying these levels. Okay, but just for now, I want you to understand the importance of these levels and the way that you can use them in your trading going forward. So until the next video, I look forward to speaking to you soon. I hope you enjoyed it. And if you have any questions at all, please feel free to drop us an email or post them below the video. Take care now, and I'll speak to you in the next video.